You are looking at the implied open for the S&P 500 futures hovering right at 5,840. And the overnight session has been, frankly, incredibly volatile.
Yeah, the pre-market volume is already massive.
It is. We are so glad you're here with us today for this deep dive. It is Wednesday, March 11th, 2026. The opening bell hasn't even rung yet, and the stack of source material we are tearing through this morning is intense.
Highly detailed, unfiltered institutional briefing notes. The raw data from the trading desks.
Exactly. And our mission today is to decode that desk jargon and extract the most crucial insights driving the global markets right now for you. We are going from geopolitical front lines to the cloud computing boom and, believe it or not, straight to the soup aisle.
Yep, the soup aisle, it's that kind of market.
Okay, let's unpack this. Setting the macro environment, I mentioned those S&P futures at 5,840, but the broader market is wrestling with a critical technical level at 6,800. The global sentiment in the notes is technically labeled neutral, but
That's a very tense neutral.
right, highly volatile.
That underlying tension is the key. The market right now is essentially trapped in a vice grip between two massive opposing forces. First up, the 8:30 a.m. CPI print.
Consumer price index.
Right. We're getting the February inflation data, and the street consensus is hovering right around 2.5% year over year. And the stakes for this specific decimal point are astronomical for anyone managing capital today.
So if you're managing a portfolio, why is that 2.5% holding the entire market hostage this morning?
Because it dictates the cost of money. Look, a hold on interest rates at the March 18 FOMC meeting next week, that's 99% priced in. Everyone accepts the Fed isn't moving rates next week.
Sure.
But the real target the market cares about is the summer. If we get a hot inflation number today, I mean, even a fraction higher than that 2.5%, it completely kills any lingering hopes for a June rate cut.
A hot CPI print just slams that door completely shut.
Exactly. And if the CPI is the first force in this vice grip, the second is the geopolitical war premium.
The overnight session notes are heavy on this.
It's very heavy. We're looking at a rapidly escalating regional conflict in Iran, fresh military strikes in the Strait of Hormuz. It has triggered what the institutional desks are literally calling an epic fury energy spike. Brent crude oil is hovering near $105.
$105 a barrel, which, that doesn't just stay in the commodities market. It bleeds into shipping, manufacturing, the cost of everything on the shelves.
Which feeds right back into the inflation problem we just talked about. It's a compounding loop.
Now, looking purely at the market mechanics today, I want to introduce two major political data points from the sources. And I want to be very clear to you listening, we are just reporting the facts of the source material here without taking any political sides.
Right. Strictly the math.
Strictly the math. First, the Supreme Court has just gutted the president's tariff powers. Second, former President Trump's recent war is ending rhetoric is actively causing safe haven demand to unwind. And that rhetoric is sliding the dollar index, the DXY, below the 99 handle. It's at 98.90 this morning.
What's fascinating here is how that sliding dollar actually behaves in the ecosystem of global finance. You might intuitively think, well, a weakening U.S. dollar is purely negative.
A sign of weakness.
Right. But for big tech, it operates as a massive financial tailwind.
Walk us through that. How does a weaker dollar help the Magnificent Seven?
It comes down to currency conversion. Imagine one of these tech giants selling a massive enterprise software package in Europe. They get paid in euros. If the U.S. dollar is weak compared to the euro, those euros suddenly translate back into a significantly higher number of U.S. dollars when they report their quarterly earnings.
So it's like a hidden discount code for international sales.
Exactly. It inflates their balance sheet without them having to sell a single extra product.
So what does this all mean? If you're trying to make sense of the economy, it feels like the traditional rules of finance are completely upside down right now.
And the notes highlight exactly why it feels that way. They call it the pain trade, or the recession reflex. Essentially, retail investors are currently falling into a massive institutional trap.
The recent payroll miss.
Right. The economy unexpectedly lost 92,000 jobs. Retail sees that and reacts based on an old, outdated playbook.
Because the old playbook says bad economic news, losing 92K jobs means bond yields drop, which forces the Fed to pivot and cut interest rates to stimulate growth.
That used to be the case. But the hidden reality in today's notes is a jobs-to-yield decoupling. Despite the massive job losses, the 10-year Treasury yield isn't dropping, it's creeping higher.
It's holding steady at 4.14% right now.
Yeah, and in the overnight session, it was aggressively testing 4.25%.
Which feels completely counterintuitive to the retail crowd. Why is the yield going up if the job market is going down?
It ties back to that epic fury energy spike. The inflation we have right now isn't from people spending too much. It's supply-side inflation, driven by 105 balloons and the Middle East conflict. The Fed cannot print more oil.
Right.
They can't lower rates to fix a physical supply chain disrupted by military strikes. Because that inflation is so sticky, the Fed's hands are tied. They cannot pivot no matter how bad employment looks.
So retail investors are sitting in a car, they see a bad jobs report, and they think the Fed is about to hit the gas pedal. They pile into the back seat, buying the AI dip, assuming the car is accelerating into a bull market.
But the transmission is shot because of the oil shock. The car isn't going anywhere. Meanwhile, the institutional money writing these briefing notes is quietly slipping out the side door and getting onto a much safer train.
And the notes are very explicit about where that smart money is going. They are rotating heavily into halo stocks. HALO, heavy assets, low obsolescence.
Utilities and energy. Companies that require massive physical infrastructure, the heavy assets, but provide services society absolutely cannot function without.
Low obsolescence.
Yeah.
Even with high interest rates, people still need to turn their lights on.
Exactly. It guarantees steady revenue. When high-flying growth stocks look risky because the Fed can't cut rates, billions of institutional capital quietly flow into halo sectors for protection.
Here's where it gets really interesting. The pre-market briefing notes give us the specific gappers illustrating this contradictory environment. Let's look at the movers.
The defense sector is a prime example. Rheinmetall, ticker RHM, they're surging 4.2% in the pre-market.
Massive German defense contractor. It's fascinating to see the raw math of geopolitics play out on a balance sheet.
They beat fiscal year 2025 earnings and raised 2026 guidance. This is directly fueled by a massive backlog of munitions orders. As the Iran conflict escalates, that war premium shows up directly in their revenue.
Which brings us to a transition from extreme global danger to domestic comfort. My favorite detail in this stack of research, the Campbell's Company, ticker CPB.
The soup indicator.
The soup indicator. Up 3% pre-market on a beat-and-raise report. With the broader U.S. economy cooling to a sluggish 1.4% GDP growth, the irony here is incredible. When the world gets scary military strikes, stubborn inflation, overnight volatility, Wall Street literally buys soup.
The ultimate consumer staple safe haven.
Just picture these intense institutional traders, stressed about complex derivatives, aggressively buying shares of chicken noodle soup.
It provides an anchor, but we can't just look at defensive posturing. The digital infrastructure sector is also moving heavily. The notes provide a massive reality check on the cloud sector through Oracle, ticker ORCL.
Oracle just incinerated the bear case with a Q3 earnings blowout.
Incinerated it. Revenue hit $17.19 billion, up 22%. But the staggering metric is their AA, infrastructure as a service, up 84%.
84% for a legacy company that size. It means companies aren't just buying software. They are aggressively renting Oracle's computing power.
And that kills the CapEx cliff theory.
Right, the fear that major tech companies were spending too much on AI hardware and that spending would fall off a cliff.
Oracle's numbers prove money is still heavily flowing into high-performance compute. The institutional desk lays out the battle lines for Oracle today. The bull case breaks through a critical resistance level at $169.76.
With a gap and go target of 176 cents.
Yes. But the bears are defending a floor of $149. Their argument is Oracle has a negative $24 billion in free cash flow from all this AI spending. If the market panics about credit risk, that debt is a burden, and $149 will be tested.
Speaking of massive AI spending, the undisputed king of the sector, NVDA, ticker NVDA. The notes have a deep dive ahead of their GTC 2026 conference.
The overnight catalyst is Jensen Huang, pitching a $1 trillion build-out. NVIDIA is attempting to move their defensive moat from just physical silicon to a recurring revenue software ecosystem called NemoClaw.
NemoClaw. Sounds like a supervillain weapon, but it's brilliant for enterprise AI. Lock companies into your software, and they can't switch to a cheaper microchip later.
Exactly. The technical levels reflect the stakes. A pre-market momentum trigger at $192, targeting the psychological $200 barrier.
But there's a floor.
Yes, a structural floor at $170. If that Middle East conflict sours risk appetite, heavily weighted tech like NVIDIA could slide back to $170 regardless of NemoClaw.
Let's look at one more mover. A completely different corporate battle. Walt Disney. Ticker DIS. highly shorted right now,
Very highly shorted. 17% of the float.
meaning a massive portion of the market is betting real money Disney's price will fall.
And they have reasons. Traditional linear TV revenue is in free fall, down 16%.
But their streaming business is finally scaling profitability. It's a tug of war between the dying linear model and the growing digital one.
Which creates an explosive technical setup, a potential short squeeze trigger at $108.55.
If it breaks $108.55, traders betting against Disney start losing massive money. They are forced to buy shares to cover, shooting the price up even faster.
That rocket fuel targets $112. However, the bear scenario sees a real risk of dropping to $94 if the market focuses on free cash flow concerns and the lingering CEO transition uncertainty.
It's wild. Rheinmetall, Campbell's, Oracle, NVDA, Disney each is a perfect microcosm for the macro forces we talked about.
If we connect this to the bigger picture, all this pre-market volume feeds into the overarching market technicals. The institutional desks describe the current environment as a liquidity trap.
What are the actual lines in the sand today?
The S&P 500 has a definitive line at 6,780. If breached, the notes project a painful test of the 200-day moving average down at 6,582.
And the Nasdaq 100, heavily weighted toward tech.
Arguably in a more precarious position, its line is 21,400. The terminology is stark. A drop below 21,000 signals a plunge directly into what they call the Valley of Death at 20,500.
The Valley of Death. High stakes before the bell even rings.
The market is tightly coiled, reacting to sticky inflation and 105 oil. The explicit advice from the desk is to avoid chasing breakouts. Do not buy just because it's going up. Do not panic sell because it's going down. The volatility is designed to trap you.
So, why does this dense briefing matter to you? Beneath the confusing daily headlines about inflation, overseas strikes, and AI fatigue, there is a clear mechanical tug of war. If you understand these institutional flows, why smart money rotates into halo stocks, or the resilience of cloud infrastructure through Oracle, you see past the noise.
You stop being the retail investor trapped by the recession reflex.
Exactly. You start understanding the actual grinding mechanics of the global economy.
In a market whipped around by century-old energy crises and trillion-dollar AI buildouts, your most valuable asset is your critical thinking. Objectively looking at the raw data and refusing to blindly follow the retail herd into a volatility trap.
Well said. Before we wrap up, I want to leave you with a final provocative thought. We talked about the war premium disrupting physical supply chains and NVIDIA and Oracle building the digital infrastructure of the future. But if physical borders remain fractured by war and AI becomes the single most critical infrastructure a nation can possess, do we eventually see the rise of sovereign AI? Instead of a globally connected digital economy, does the internet fracture into heavily armed, walled-off digital islands where every country hoards compute power just like they hoard oil today? Something to think about as you watch the opening bell. Thank you for joining us on this deep dive.